Okay, so I've been getting a few comments about leveraged ETFs, in particular TQQQ, which is a three times leverage on the QQQ. This is the culprit on my brokerage, and I mean, in terms of popularity, almost 15 billion in assets under management, and the performance is great on paper. We can see in the past 1 year up 114%. The description says the investment seeks daily investment results before fees and expenses that correspond to three times the daily performance of the NASDAQ 100 index. So I can see why this is attractive. They look at that description, they see the performance, and they think this is a great investment. However, I have to say, for most people, this is not a good investment. And I know that's very counterintuitive, and a lot of people like this, so I'm gonna get some hate on this video, but I would just say, allow me to explain my research because I love finding good investments, but I just don't think this is a good investment, and let me explain why. Also, the obligatory go ahead and subscribe to the channel if you haven't, just in case YouTube decides to stop recommending the channel. So QQQ, this is the base ETF that the leverage is based off of. Now, the first thing I want to look at is just the expense ratio, keeping it basic, and with QQQ, it's 0.2%. So if we come over to a basic fee calculator with 10,000 bucks, 10 years of time, 0.2% expense ratio, we're looking at just under 1,000 bucks in fees. In contrast to that, TQQQ is 0.95%, which isn't massive, but if we put that in on the calculator, 0.95, we're going to see a pretty drastic difference, almost 4,500 bucks. So that's the first con of this ETF, but of course people are going to say that it's justified because the returns are so amazing. And in my opinion, this is where the issue comes into play because people look at the graph, this is TQQQ versus QQQ, and it looks like the leveraged ETF is doing significantly better over long periods of time. And I'm going to go ahead and say that that may or may not be true, but there's a hidden risk that is not being shown in these charts. And if I come to the official website, we can begin to understand what this risk is. So the ETF seeks a return that is three times the return of its underlying benchmark for a single day. It's even in bold right here. It says, due to compounding of daily returns, holding periods of greater than 1 day can result in returns that are significantly different than the target return. So right there, that's the major disadvantage with leveraged ETFs. They're not judged based off of a month or a year. It's on a daily basis. That three times leverage is daily. And what that means is over long periods of time, if you choose to do that, which is highly advised against, the base index and the leveraged one can have drastically different returns in completely opposite directions too. And to dive a little bit deeper, let's begin with this article. So this is known as volatility decay. Don't hold leverage ETFs long term. And I want to begin right here. And it says, since stocks will almost certainly go up over the long term, 30, 20, 10 years, shouldn't long-term investors all invest in leveraged ETFs instead? And the answer is a resounding no. Leveraged ETFs are designed for short-term trading. Due to a phenomenon called volatility decay, holding leveraged ETFs long-term can be very dangerous. So this is that hidden risk with these leveraged ETFs, and they have a few examples that go over different scenarios and how this volatility decay can affect returns. And I actually want to switch to this article because it does a slightly better job with a few more examples. So the first point is that higher expense ratio because you're paying for this daily rebalancing in order to keep the fund leveraged. There's tons of financial derivatives involved, there's debt, so it's a much more complicated financial product, and because of that, they charge higher expense ratios. But because of this daily rebalancing and the volatility decay, it's not a safe assumption to assume that all because the underlying index goes up 20% over, say, 2 years, that the leveraged one is going to 3x that. In fact, that's usually never the case over longer periods of time. So here's the first example. We have the days over here. This is over a 7-day period, and the stock price begins at 100 bucks, and every day it goes up by $1. Very basic and also very unrealistic. But if we look at the returns, in this case, the leveraged ETF will do better. It also says that the returns were 50% over a 50-day period, while the leveraged ETF returned 234%, which is significantly more than the leverage ratio, which should only be 150%. So, taking it one step further, to understand why this difference is happening, they have another example. So, it's the same time period, 10 days, but in this case, you begin with the same 100 bucks, then it goes up to 110, back down to 100, 110, back down to 100, and ultimately you end with the same $100, but there's a lot of volatility. And if we look at the returns here in red, the 3x leverage ETF, because of that volatility decay, it has significantly worse performance. So this illustrates how even though the base index can be flat for a period, the leveraged one can have massive losses. And I think this little bit here does a good job summarizing how a lot of people view these leveraged ETFs. So it says, while most TQQQ investors accept the risk of significant underperformance during bear markets, because they understand that with the leverage it will go down 3 times as much, they may not fully grasp the potential of volatility decay loss even during good or better times. So I think this serves as a great example of why you need to do proper research into investments. Now, I'm not saying you should never invest in leverage ETFs. For the short term, if you're trading and not a long-term investor, they might have a place in your strategy. But I feel like a lot of people just look at these charts, they see one line go up more than the other, and they pile into the investment. And they just don't have a full grasp of how the investment vehicle is really supposed to be utilized and the true mechanics of it, and things like volatility decay. I'm a big believer of just having a long-term strategy. If I come to my growth section of my portfolio, I think funds like ARK and WCLD are more than volatile enough on their own, and these are just pure equities focusing on high growth companies. ARK focuses on innovative companies, and WCLD has a very mathematical approach and a very high bar of entry. In fact, putting WCLD against the QQQ, we can see this ETF does outperform the QQQ. So you have lots of options if the QQQ just isn't good enough for you without jumping into the derivative market. I mean, maybe I'm just too cautious because I've been investing in the crypto market for years now, and the crypto market has a really big issue with over leverage and the use of derivatives. We're looking at the chart for BTC right now, and a lot of these corrections and sharp declines are because of over-leveraged positions. In fact, this is a pretty nice chart of the price of BTC against the level of leverage in the market. And when things are riding high and people are confident, the leverage people are taking out is at an all-time high, and when the momentum changes, tons of liquidations happen, and that's actually what exacerbates the sudden and massive declines we see in the crypto market. It's this domino effect of liquidations because people are over leveraged in the market trying to 10x their returns. In fact, just the other day, we saw this exact phenomenon happen again in the market. Crypto took a massive dip from 52,000 bucks all the way down to 42,000 bucks in a matter of just minutes. And again, that's simply because the price is going up, people got bullish, they took out leverage to 10x their return, and then all of a sudden the momentum changed, a ton of liquidations, and people lost a lot of money because of excessive risk taking. Now, I know TQQ and other leverage ETFs are completely different than massive leverage in the crypto market, but I'm just trying to say I've seen the effects of excessive leverage in markets before, and I'm very skeptical of it, and I hope that people just understand the full risk of assets like this, including things like volatility decay over time. But that's going to be the end of the video. Let us know in the comments down below what you think. If you're still watching and enjoyed, give the video a like, subscribe to the channel, all that YouTube stuff, and I'll see you in the next one.